Hey traders! In today's video, I'll be showing you the most effective method to utilize the RSI indicator. Now, first things first, as traders, it's crucial for us to pinpoint significant price levels in the market where reversals are more probable. These zones can be identified by recognizing when the market reaches relatively overbought or oversold conditions, and the RSI is excellent at helping us do just that. In this video, I'll break down the top strategies we can apply using the RSI indicator. Before we go on, if you have suggestions for upcoming videos or general trading questions, feel free to drop them in the comments below. So traders, if that sounds helpful, hit the like button to show some support, and don't forget to subscribe if you're new to the channel. I'll see you right after the intro and disclaimer. Now, when you open the RSI indicator, you'll notice a single line along with two key levels marked at 70 and 30. If the RSI moves above the 70 level, it suggests the market is in an overbought state. On the other hand, if the RSI drops below the 30 level, it signals the market is in an oversold condition. A big mistake that many traders often make is assuming that once the RSI reaches the oversold level, the price will immediately start moving up, and when it hits the overbought level, it will instantly start falling. This type of thinking is actually one of the fastest ways to blow your account using the RSI, because it just doesn't work like that. The problem with using RSI this way is that market behavior doesn't always follow those assumptions. If the market is in a strong trend, the RSI can produce many misleading signals. Here's a clear example. Notice how the price is moving in a strong uptrend, while the RSI is sitting in the overbought zone. Now, if you had entered a sell trade here expecting a reversal, let's look at what actually occurred. Instead of dropping, the price kept pushing higher, and the RSI hit overbought territory again. So, just because the RSI reads as overbought doesn't mean the price will drop back down to oversold. Prices can remain in overbought or oversold areas for extended periods. That's why you shouldn't rely on the RSI as your primary tool. Instead, you should treat it as a confirmation tool. Let the RSI support your broader market analysis. Personally, my go-to method when pairing with RSI is basic, support and resistance levels along with trend lines. Take this example, an RSI reading that indicates oversold conditions by itself can often result in misleading signals. But when the RSI is in the oversold zone and price is also sitting on a major support level, the signal becomes much more dependable. Now let's take a look at the chart. As you can see, the market is clearly trending downward. You can draw a trend line here, where price has been rejected several times. You can also draw a second trend line just below. Here's a quick tip I personally use when plotting support and resistance levels. Make sure the price reacts at least 3 times to strengthen the reliability of that level. At this point, the price is touching the lower trend line again after multiple rejections, and there's also a clear price reaction while the RSI is still showing oversold. This could signal a strong buying setup. Here's another example. In this chart, we can clearly identify a support level. Now, each time the price reaches this support level and the RSI shows oversold, the price bounces back up. We've already seen this happen twice. The price touches, then reverses, touches again, and reverses again. Now we see the same setup forming once more. The price is at the support area, and the RSI is indicating oversold conditions, suggesting another potential move to the upside. This could present another solid buying opportunity. Another effective way to use the RSI indicator is by spotting divergences. A divergence occurs when the price action of an asset moves in the opposite direction of the RSI reading. For instance, under normal conditions, when the price makes higher highs, the RSI also forms higher highs. When price makes lower lows, RSI typically follows with lower lows. But there are times when price forms higher highs, and the RSI instead forms lower highs. This situation is what we call a divergence. I know it can be challenging to detect divergence with the naked eye, which is why I use a TradingView indicator called CRS. This tool makes it much easier to identify divergences as they occur and will save you a lot of time and effort. There are 2 main types of divergences: bullish and bearish. A bullish divergence happens when the price forms lower lows but the RSI forms higher highs. This often suggests that a bullish reversal may be on the way. On the other hand, a bearish divergence occurs when price forms higher highs, but the RSI does not follow and instead creates lower highs. This indicates that a bearish reversal could take place. However, just like with traditional RSI usage, you shouldn't make trades based solely on divergence. You need a second confirmation. In my case, I also rely on support, resistance, and trend lines to validate the setup. Let's go ahead and look at a chart. As we can see, Shopify was moving in a downward trend while the price rejected this key resistance level multiple times. So, we can draw a trend line here, and the RSI is showing a bullish divergence, followed by a strong green candle that breaks above the trend line. This setup suggests a solid buying opportunity. Now let's examine another example. Here, the market is clearly in an uptrend, so you can draw a trend line connecting the rejections at several support levels. Then, we observe a bearish divergence forming. The RSI is making lower highs, but the price continues pushing to higher highs. Shortly after, the trend line is broken and a large bearish candle appears. This setup indicates a potential sell trade. Another method for applying the RSI is by using the 50 level line. The RSI is usually set to 70 and 30 by default, but for this strategy, you want to modify the settings to show only the 50 level and remove the other two. Now, we're using the center line as a trend confirmation tool instead of a reversal signal. Here's how it works. If the RSI moves above the 50 level, it's seen as a bullish signal. If the RSI falls below the 50 level, it's interpreted as a bearish signal. However, just like before, we don't want to rely solely on one tool. So for added confirmation, I'm pairing this with the stochastics indicator. Let's check out some chart examples using this approach. In this example, you'll notice the RSI moves above the 50 level, while the stochastics indicator is showing oversold conditions. This presents a strong buying opportunity. Now let's go over a few more examples. In this one, the RSI drops below the 50 level, and the stochastics is signaling overbought conditions. This points to a potential sell opportunity, as we observe the price beginning to reverse. So, I've just walked you through some of the most effective strategies for using the RSI indicator, tactics you can start applying right away. That's it, traders. Thanks for tuning in. I hope you found this video valuable and easy to follow. Now, I'd really appreciate a small favor. Just hit the like button and subscribe to the channel. It only takes a couple of clicks, but it truly makes a big difference. Thanks again for watching, and I'll catch you in the next one.